What's up everyone, welcome back to another video with the Millennial Finance. We keep hearing about how ETFs are the best thing since sliced bread. Most personal finance gurus and even legendary investors like Warren Buffett recommend the average person to invest in ETFs over picking individual stocks or even going through mutual funds. In a way, they do have a point. ETFs are more diverse, meaning they're less risky than individual stocks, and they also seem to outperform most fund managers. But with its surging popularity, many ETF providers are creating a bunch of new different ETFs, and there are so many out there for us to choose from. So, which ones are worth a consideration? Let's find out. Cha-ching! Before we start, if you want to invest in ETFs, especially those who are based in the US, then check out Rakuten or Interactive Brokers. They are the two main brokers that we use, and their links are down in the description below. Anyway, before we get into the more fancy new options that we currently have, we can't ignore the core ETFs that are by far the most popular out there. And these are SPY, QQQ, and VTI, who have the largest assets under management of all ETFs. So SPY, most of you should know this already, it tracks the S&P 500, which covers 500 of the largest companies in the US. Other popular options are VOO, which does, it tracks the same index, and it's completely a personal preference. This ETF gives us great diversification because it covers many different sectors. This showed its strength in the past 1 year because even though many of the stocks were dropping, including the big tech companies which were propping up indexes, the S&P 500 or SPY still managed to give decent returns because other commodity plays like oil and gas and miners were still doing well, which helped them outperform many other tech-focused ETFs. So this is definitely the main benefit of owning the S&P 500. It also gives you access to the largest companies in the US, meaning any growth in the US you should also see being reflected in the S&P 500. But if you want something more focused on tech and a bit less diversified, then the QQQ tracks the largest 100 companies who are listed on the Nasdaq exchange. So technically, this isn't a tech ETF. It's not built that way. It's just meant to track the 100 largest companies who listed on the Nasdaq. Somehow though, most of the companies who list on the Nasdaq exchange are tech companies, which makes this ETF very tech heavy. It's also a bit more concentrated because it only has 100 stocks in it compared to the SPY's 500. Both of these ETFs generally move in the same direction anyway, but those small differences in terms of how much they go up and how much they go down on different days can make a difference over the long term. We all know that tech has been leading the stock market over the last 10 years. It has taken over from things like oil and gas as the largest companies in the world, and because of this, the QQQ has definitely outperformed the S&P 500 over the last 10 years. However, in the last 1 year, the QQQ has underperformed the S&P 500, and this is for the reason that I talked about earlier. The QQQ is very focused on tech and tech took a beating, whereas the S&P 500, yes, they do have a lot of tech companies as well, but the commodity plays help offset some of these losses. Finally, there's VTI, which is definitely the most diverse option out of these three. With a massive 4,096 stocks under its belt, it covers the entire US stock market and attempts to track its performance. The difference for this versus the S&P 500 is that this ETF also takes into consideration small and mid-cap companies. It still gives a bigger allocation to larger companies, of course, which means that tech is still the biggest allocation or has the biggest weightage in this ETF. This is for those who want even more diversity in their portfolios and want some exposure to small and mid-cap companies just in case they outperform large caps in the next few years. Anyway, now that we've covered the core ETFs that should build the base of most portfolios, we can now get into some thematic ones which can be a bit more fun for areas that we're especially bullish on moving forward. Do note that as usual, this is not financial advice. There's just so many different ETFs out there for you to choose from. These are just some of my personal favorites. You still have to do your own research. At the end of the day, it's your money. Anyway, the first thematic area that I want to invest my money in is global clean energy, and the ETF of my choice is ICLN. So this is one of my highest conviction holdings because I just don't see a future where we don't pivot towards cleaner and more renewable energy sources. It's truly one of the set and forget moves that I have, and I'll continuously add to this position even if it's not the flavor of the month and the stock keeps going down. In this particular moment though, clean energy stocks are definitely gaining in popularity. This is because the US government is passing an act that will see the largest investment into clean energy in history. So while this certainly helps the case and is incredibly bullish for companies within this industry and for the industry as a whole, I have been an investor in ICLN for over a year, and even if this act doesn't get passed, I still will invest into this ETF. So this news is definitely helping in the short term for the whole industry, as we're seeing many solar names setting up their prices, and it looks like they will be the leaders in the next bull market. However, ICLN is not limited to just solar energy. They also invest in other companies who produce renewable energy for sources like wind and hydroelectric. So geographic wise, they're not too concentrated in the US. Clean energy can be produced anywhere. So less than half of this entire ETF is invested into companies who are based in the US. Next up, we have SPGP. This one isn't really thematic, but in my opinion, it's a pretty cool ETF to invest my money in. What it does is it selects 150 companies from the S&P 500 that has the highest growth scores. Essentially, it's buying into high growth companies who have reasonable valuations, so it won't really invest in companies who are stagnant or those, high flyers, high revenue growth with zero profits. This can be seen clearly in the fund's holdings. It's one of the few ETFs out there that doesn't have the mega tech companies as its top holdings. It actually has eBay as the top holdings, and the top sector allocation right now is actually finance. I really like this ETF because, who doesn't like fast growing companies at a reasonable price? It also gives me exposure to different sectors because, like I said before, most of my individual portfolio is based off of tech stocks. This one though, it doesn't really care about the sector. As long as the company is doing well and the valuations are fair, then it will include it in this ETF. Over the last 10 years, SPGP has actually slightly outperformed SPY, which is why I actually use this ETF instead of SPY. I don't invest in both. I use this as sort of like a proxy to the S&P 500. Moving on, I'm sure some of you already know that I am bullish on semiconductors for the future, which is why I invest into the ETF named SMH. With so many companies out there now requiring chips in development of their products, it's no surprise that this industry is projected for a decade of growth and for it to reach $1 trillion by 2030. I mean, we saw the importance of chips during the global chip shortage that we had over the last 1 year. Just looking at some of the impacts of this, personal computers were getting more expensive, Sony couldn't produce enough PS5s even though everybody wanted one, and Toyota had to slash production forecasts, and this resulted in a 42% decline in their profits. Even Canon, a printing company, had to allow users to use printer ink that didn't have a chip in it because they just didn't have enough chips, and what this meant was that users could now use counterfeit ink to put into the printer and it would work. With nearly everything in our daily lives now having a chip in it and so many companies relying on these chips just to run the day-to-day business, it made sense for me to have a position here. One of the most well-known players in the industry, being Nvidia, is tipped to continue its growth story from the last 2 years and to become one of the largest companies in the US soon. Many people even say that, how the FANG acronym, how N is for Netflix, many people say that they should kick out Netflix because they're not good enough and they should replace it with Nvidia. Anyway, since I have to admit that I don't fully understand the technicalities behind all of this, that's the reason why I decided to invest in this ETF instead of trying to pick and choose from different companies. Previously, I did own Nvidia, I did own a bit of AMD and even Taiwan Semiconductor, but because I don't really understand and I don't want to catch up with the news of this industry, I would just invest in the ETF and it will cover all of the semiconductor companies. The next thematic ETF in my list is CLOU or CLOU, which invests in companies who stand to benefit from the growing adoption of cloud computing. There's a much bigger ETF that covers the same industries and it's called SKY, SKYY, but the reason that I went with CLOU is because that they invest in slightly smaller and mid-cap companies. If you wanted a safer bet though, if you wanted the larger companies, then you could go for SKYY just to get the same exposure to this industry. Anyway, as an industry, I believe that there are structural tailwinds for these companies even though the pandemic did bring forward a lot of growth. It doesn't make sense for these companies to go back to the pre-digitalization era, so growth should continue to be strong as people expect a $1.5 trillion industry by 2030. A lot of these companies did get extremely overvalued from the bull market in the last 2 years, but as we all know, these high-flying growth stocks have taken a massive beating, which actually means the valuations of this ETF right now is actually pretty decent. To be completely honest, if we went back to, let's say 2021, I wouldn't have invested into this ETF because even though the industry fundamentally is very strong, the valuations were just way too high. So this is actually a good time to invest in this ETF if you're bullish. I just invested, a small position into my long-term portfolio last week. Similar to the semiconductor industry, if I decided to pick and choose individual names, I would have to do way too much research and I would probably end up with too many stocks in my portfolio. Since I'm bullish on the sector as a whole, I've decided to go the route of investing into this particular ETF. So this one is a bit more risky compared to the previous ones, but for my risk profile, I believe that it's worth a place in my portfolio. So the final ETF that I talk about in this video won't really be thematic to an industry, but more so to specific regions, being the emerging markets, and the ETF is called VWO. I'm sure that some of you already know this ETF. I think that Stashaway and a few other robo-advisors previously did have this as part of their portfolios. So with so much exposure of our investments already in the US, this is not just limited to our own investment portfolios. This includes stuff like Amanah Saham and EPF. I think that it's a good choice to slightly diversify your portfolio, especially with upcoming markets. I could have went with something like, Europe, which is a lot more established, but I just don't find the growth opportunities to be so exciting. With the ETF also not being too focused on countries like China and Hong Kong, you also get good geographical diversity. I wouldn't want to see emerging market ETF just to see that 80-90% of the companies are all based in China. In particular, I like that this ETF gives me exposure to countries like India, Brazil, and Indonesia, which in my opinion are set for growth in the next decade. At the same time, you still get access to the mega companies in Asia, companies like Taiwan Semiconductor, Tencent, and Alibaba. Like I said, this is more to diversify my portfolio a bit, but it's still sticking with the large growth theme. This will probably be one of the largest single holdings I have in my portfolio for the simple reason that nearly all of the other ETFs that I talk about are very focused on the US. So since this is the only one that is focusing on excluding US, I would put more of my money into this single ETF. So ETF investing can be very simple as many people just recommend the core ETFs like the S&P 500, the QQQ, or VTI. However, there are opportunities for us to look into thematic ETFs to invest in areas that you're especially bullish on to complement our overall portfolios. Personally, I've got a good mixture of ETFs spread across my overall portfolio that includes a good mix of, slow and steady versus very high growth. If you want to invest in any of these ETFs or, maybe you have something that you're more bullish on, then check out Rakuten or Interactive Brokers. They're both great options for you if you want to invest in US-based ETFs. You can use our link down in the description below. Thanks for watching this video to the end, guys. Give us a huge thumbs up and subscribe to our channel if you haven't already. Let us know down in the comments below, which ETFs do you invest in? See you guys in the next one. Peace out.